Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, what are you not allowed to put into a self-directed IRA? This is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Type them over now so that we can be sure to get to them all. Let's get started. So what are you not allowed to put into a self-directed IRA? Self-directed IRAs are popular because they allow investors to move beyond traditional investments like mutual funds and stocks, and instead invest in alternative investments like real estate, private equity, promissory notes, cryptocurrency, precious metals, and other alternative assets. However, despite the flexibility, the Internal Revenue Code places strict limitations on what a self-directed IRA can invest in and how it can transact. Understanding these restrictions is critical because violating the rules can cause the entire IRA to become immediately taxable and subject to penalties as well. Today, we're going to cover what investments are prohibited in a self-directed IRA, what transactions are not allowed, the consequences of violating the rules, the key differences between a self-directed IRA and a solo 401k plan. Let's talk about investments not allowed in a self-directed IRA. Give me a moment while I pull up that slide here. So under Internal Revenue Code Section 408, certain assets are explicitly prohibited in an IRA. Such an asset is life insurance. A self-directed IRA cannot purchase life insurance policies. This restriction applies regardless of whether the policy is a whole life, universal life, term life, variable life. And why does this matter? Well, one major advantage of a solo 401k over a self-directed IRA is that a qualified plan, which a solo 401k plan falls under, may invest in life insurance, provided it follows the incidental benefit rules. So these rules generally limit the policy value relative to plan contributions, but the strategy is allowed within a qualified retirement plan like a solo 401k. So this is one of the key structural differences between IRAs and solo 401k plans. Other types of disallowed investments in a self-directed IRA include collectibles, including artwork, antiques, rugs, stamps, coins. Of course, certain coins are allowed, such as gold and silver coins, provided there are certain purity and type. For example, Canadian maple leaves and American eagle coins are allowed, whether silver or gold. Other disallowed investments include alcoholic beverages, and of course, other unconventional types of collectibles like playing cards, whether we're talking about Pokemon or baseball or football cards. You also cannot invest in gems. So you used to be able to invest a self-directed IRA in diamonds, but that's no longer allowed. So gems are not allowed either. Now, also S corporation stock Neither a self-directed IRA nor a solo 401k can invest in S corporation stock. The reason is simple. The S corporation rules restrict shareholders to eligible individuals and certain trusts. It does not allow for retirement accounts, whether a solo 401k or an IRA, to be a shareholder in an S corporation. Of course, both a self-directed IRA and a self-directed solo 401k may process a promissory note to an S corporation, which is different than an equity investment. But of course, other rules come into play if it's going to be a promissory note investment, such as it cannot be your own business or a disqualified party's business, for example. So as a result, retirement plans cannot own shares in an S corporation. Before we talk about prohibited transactions in a self-directed IRA, let's check for some questions here. Let's see. Here's a question. I opened my solo 401k in January of 2026. I deposited $46,000 into a post-tax account. So you need to clarify whether you deposited it to the Roth solo 401k or the voluntary after-tax solo 401k, because the solo 401k plan allows for both Roth solo 401k contributions, voluntary after-tax solo 401k contributions, which are both made with after-tax funds. So you need to clarify that point there. I waited 2 weeks to transfer funds to my Roth IRA. I submitted the after-tax to Roth conversion form. Okay, so that further clarifies that you made a voluntary after-tax solo 401k contribution, and you then converted it to the Roth IRA. A few days ago, I noticed the post-tax account now has about $40 of interest reported. How should I handle that? Transfer it to a Roth IRA as a taxable transfer? Good question. Let me pull up some slides here. So here's an example of a one participant solo 401k plan that would be sponsored by your self-employed business. Let's say your self-employed business is an S corporation. So the S corporation sponsors the solo 401k plan, meaning that it's by virtue of your self-employed business that you can open a solo 401k plan. That's one major difference between a self-directed IRA and a solo 401k plan. And that is that in order to open a solo 401k plan, you have to be self-employed. Whereas with the self-directed IRA, you are not required to be self-employed. So in this example, the S corporation sponsors the solo 401k plan. A solo 401k plan is a qualified defined contribution plan, meaning that it has to separately track each participant's funds and fund sources. So here's an example of a one participant plan. Here's an example of a two participant plan. Under a one participant plan, the individual is going to have three separate holding accounts, aka bank or brokerage accounts, to hold the various solo 401k fund sources. And those are pre-tax, Roth, and voluntary after-tax. So it's still considered one solo 401k plan. A solo 401k plan, just like all other 401k plans, it is a retirement trust. So the solo 401k plan will have its own separate employer identification number. You do not use your business EIN. You use the EIN for the solo 401k when opening the holding accounts. So if you opened up, let's say, three separate brokerage accounts at Fidelity Investments for the self-directed solo 401k plan, because yes, Fidelity Investments does offer their own solo 401k plan, but they will also provide what they refer to as non-prototype company retirement brokerage accounts for a self-directed solo 401k offered by a provider like my solo 401k Financial. So we would have helped you to open up three separate brokerage accounts at Fidelity. You would then make your voluntary after-tax solo 401k contribution to the brokerage account labeled after tax. You would then convert those funds to the Roth Solo 401k plan. You would then complete our online Form 1099-R conversion form. And that's how we collect the necessary information to report that mega backdoor Roth Solo 401k conversion to the IRS. You can find that form under our Forms tab. In your situation, you converted all the funds in that voluntary after-tax account, which is what you're supposed to do. Hence why there are separate brokerage accounts, because you want to isolate each source of funds. So when you go to process a conversion, it doesn't impact the other fund sources. That's the pre-tax or the Roth. So you converted all the funds in the voluntary after-tax account to the Roth Solo 401k plan. Now, some interest accrued that then flowed into that voluntary after-tax account. You can leave those funds in the voluntary after-tax account. As a matter of fact, you want to leave at least a few cents in there at all times so that the brokerage firm, in this case Fidelity, does not close that brokerage account automatically. Fidelity is notorious for closing down non-prototype brokerage accounts that have a zero balance for a long period of time. So you want to leave at least a few cents in that voluntary after-tax brokerage account so you can use it in future years when you perform the mega backdoor Roth Solo 401k going forward. So the interest that accrued after the fact, you can just leave it in that voluntary after-tax account and everything's in compliance. And then next time that you go to process another mega backdoor Roth Solo 401k conversion, you can convert those funds along with the additional contribution that you make. So in short, you don't need to do anything. I would just leave the funds in the voluntary after-tax account for now. Okay, good question. Let's see if we have some more questions here. All right, I don't see any other questions for now. Let's get back to our topic, which is what are you not allowed to put into a self-directed IRA? Again, go ahead and type over questions regarding today's topic or any other topics surrounding self-directed IRAs and even solo 401k plans. And we'll go ahead and answer those questions live on the air. So let's talk about prohibited transactions and a self-directed IRA. So in addition to prohibited assets or disqualified investments, disallowed investments in a self-directed IRA, the IRS also prohibits certain transactions between the IRA and disqualified persons. These types of prohibited transactions typically apply to a solo 401k plan as well. So these rules are designed to prevent the IRA participant or the solo 401k participant from personally benefiting from their retirement assets before retirement age. At the end of the day, the government created IRAs and solo 401k plans to save for retirement. So in the context of a self-directed IRA, let's talk about disqualified parties. So disqualified parties are individuals or parties that your self-directed IRA cannot perform transactions with. So the IRA participant slash owner, the IRA owner's spouse, the IRA owner's parents, grandparents, the IRA owner's children, for example, the IRA owner's business. So the IRA owner may own a business. So we prohibit it for his or her self-directed IRA to perform transactions with his or her business. You also cannot contribute property that you personally own or any of the disqualified parties own. So a self-directed IRA cannot purchase or receive property you already own. Examples of prohibited transactions include selling your personal rental property to your self-directed IRA. That same rule applies to solo 401k plans. Transferring your land into your IRA. So let's say you own some farmland or some vacant land. It would be prohibited to sell or exchange that land that you or disqualified parties personally own or your business personally owns to your self-directed IRA or even to a solo 401k. So you cannot exchange personal assets with your IRA or solo 401k. Similarly, property owned by disqualified persons cannot be sold or transferred to the self-directed IRA or to a solo 401k plan. All investments must be purchased directly by the IRA or the self-directed solo 401k from unrelated third parties. You also cannot perform what's referred to as an indirect transaction or strawman transaction. So the rule of thumb is that you cannot do indirectly what you cannot do directly with the self-directed IRA or a solo 401k. For example, if you own your own personal home or a rental property, you can't sell it to your neighbor and then have your neighbor sell it to your self-directed IRA or your self-directed solo 401k plan. That's still a prohibited transaction. Now let's talk about the consequences of prohibited transactions. So the penalties for violating the prohibited transaction rules are severe. If a prohibited transaction occurs, the entire self-directed IRA is deemed distributed as of January 1st of the year the violation occurred. Same rule applies to solo 401k plans. The full value becomes taxable income. And if the IRA participant is under age 59 and a half, an additional 10% early distribution penalty will also apply. An example, if a self-directed IRA worth $500,000 engages in a prohibited transaction, the full $500,000 becomes taxable. Early withdrawal penalties may apply. And what is more, if the prohibited transaction occurred 3, 4, 5 years ago, it's going to be taxable as of the year in which the prohibited transaction occurred. So you're going to have to pay back taxes. Because when it's considered a prohibited transaction, is effectively a distribution, which is subject to federal taxes and possibly state taxes. So you would have to go back and amend your personal tax return for that particular year. So this is why compliance with prohibited transaction rules are crucial or is crucial. Now let's talk about participant loans. So another key difference between a self-directed IRA and a solo 401k plan is the ability to borrow from the solo 401k plan. IRAs do not allow for participant loans. So any attempt to borrow from an IRA would be treated as a distribution, triggering taxes and potential penalties. The solo 401k participant loan rules, however, do allow for loans. So a solo 401k plan allows the participant to borrow from the plan under IRS rules. Let's talk about those rules. So when a solo 401k participant wants to borrow from their solo 401k plan through a solo 401k participant loan, each participant can borrow from their respective funds. They can each borrow up to 50% of their respective solo 401k balance for a maximum of $50,000. So each could conceivably borrow up to $50,000 if they have enough funds in the plan. For example, if both spouses are self-employed in the same self-employed business, then both spouses can borrow from the solo 401k plan, resulting in 2 solo 401k participant loans. Here's an example of a two-participant plan, which is often the case where both spouses are self-employed in the same business. So let's say Jake and Sally are self-employed in the same S corporation. So the S corporation sponsors the solo 401k plan. Jake and Sally would each have separate holding accounts under the solo 401k plan, resulting in a total of 6 separate bank or brokerage accounts. So again, it's not considered 6 separate solo 401k plans. It's one plan, but each participant is required to have separate holding accounts for their funds, including fund sources. Hence why this slide here reflects 6 brokerage accounts or bank accounts, because you need to have a pre-tax Roth and an after-tax for each participant. You don't have to fund all these different holding accounts. You don't have to open up all the separate holding accounts at once. They can be opened as needed, but they are already built into the plan. So back to the participant loan example, Jake and Sally can transfer their IRAs or former employer plans to the solo 401k plan, and then they can each borrow from their respective funds under the solo 401k plan. And if they each have enough funds under the solo 401k plan, they can each borrow up to $50,000, which is the loan maximum per participant, resulting in a total amount of $100,000 in borrowed funds between both participants. Let me get back to my prior slide here. Let's talk about the loan solo 401k participant loan terms. So the loan is generally repaid within a 5-year period. So the payments consist of principal and interest. They're scheduled payments, monthly, quarterly, over a 5-year period. And when you borrow from the plan, there's no credit check because you're borrowing from your own 401k funds. And then the proceeds will flow from your respective solo 401k participant account to your personal bank account, because you are the one borrowing from the plan. So you do not want those funds to go to your business bank account. They need to flow from the solo 401k to your personal bank account when you're borrowing from the plan. Okay, let's give an example of a solo 401k loan. Let's say that you have $120,000 in your solo 401k plan because you transferred an IRA or a former employer plan to the solo 401k. You can always transfer unlimited amounts of IRAs with the exception of a Roth IRA, as well as you can also transfer former employer plans to the solo 401k plan. There's no limit, and those transfers do not count towards your annual contribution limit. So under this example, let's say that Sally transferred $120,000 from her self-directed traditional IRA to the solo 401k plan because she's self-employed. She doesn't employ any non-owner full-time W-2 employees in her business or any other business that she owns. So she's eligible to open a solo 401k plan. So Sally can borrow 50% of $120,000 up to the maximum of $50,000. So her maximum loan is going to be $50,000. So even though she transferred $120,000 from the self-directed IRA to the solo 401k plan, because of the solo 401k participant loan rules, the maximum she can borrow is $50,000. So she'll be able to borrow $50,000 from her solo 401k. She can use those funds that she borrows for any purpose. She can use them for personal use, for funding her business, paying off debt. She can even use them towards the purchase of her primary residence. If she uses those proceeds towards the purchase of her primary residence, then she can pay that loan back over a 15 or 30-year period. All other purposes is a 5-year maximum loan period. So the loan, of course, is repaid back to your own solo 401k, consisting of principal and interest. So this strategy can provide liquidity without triggering taxes because it's a participant loan. Now, let's talk about investing in C corporations. While retirement accounts like self-directed IRAs and solo 401k plans cannot own S corporation stock, as I mentioned earlier, there are ways that you can invest a solo 401k or a self-directed IRA in a C corporation through a stock purchase. However, special planning considerations apply. So why do investors sometimes use a C corporation structure? Well, a self-directed IRA can, can invest in an LLC or a C corporation, typically for making passive investments like real estate or other types of alternative investments, especially in the context of real estate. When a self-directed IRA invests in an LLC for the purpose of investing in real estate, so investing in passive properties, for example, it could trigger a tax known as unrelated debt finance income tax. If that IRA or that LLC that's funded with that self-directed IRA utilizes borrowed funds, debt financing for investing in real estate. So as a result, individuals will set up a C corporation instead of an LLC. So this structure allows the IRA to own shares of the C corporation, so stock shares. So now the C corporation has the self-directed IRA as the sole shareholder. The result is that the self-directed IRA is now going to be subject to unrelated debt finance income tax if the C corporation uses debt financing or a non-recourse loan for investing in real estate. So this creates basically a way to avoid having the IRA pay unrelated debt finance income tax, which is typically a 38% tax rate. However, because it's a C corporation, the C corporation will have to pay corporate taxes, which is currently a 21% tax rate, which is lower than the 38% tax rate that would apply if it's subject to self-directed IRA to unrelated debt finance income tax. So some final thoughts here. This self-directed IRAs offer powerful diversification opportunities, but they come with strict IRS limitations on both investments and transactions. So investors must avoid prohibited assets like life insurance and collectibles, transactions with disqualified persons, transferring personal property into the self-directed IRA. Violating these rules can result in the entire self-directed IRA becoming taxable. Now, for self-employed investors seeking additional flexibility, a solo 401k may provide advantages over a self-directed IRA, including the ability to borrow 50% of their solo 401k balance, not to exceed $50,000, the option to invest in life insurance, and typically greater flexibility for advanced retirement planning strategies. For example, when you invest a solo 401k in real estate, the solo 401k can obtain a non-recourse loan. So it can take on debt financing for investing in real estate. When a solo 401k uses a non-recourse loan, it will not trigger unrelated debt finance income tax, which does apply to self-directed IRAs unless they utilize that C corporation blocker I mentioned earlier. So if you are self-employed and exploring advanced retirement strategies, understanding the structural differences between a self-directed IRA and solo 401k can help you determine which solution best fits your long-term investing goals. Okay, I think we've come to the end of our session here. I don't see any questions. So that's it for today's solo 401k session. Thank you so much for investing your time with us. We know your time is valuable, but your retirement future depends on it. We would really appreciate it if you like us across the various social platforms. If you like us on our YouTube channel, subscribe to our channel. That way you receive notifications of all the daily content that we deliver each day. It also helps us to continue to grow this great community. Until next time, have a good rest of the day.